Okay, everyone, let's get going. Happy Tuesday. Happy October. Happy fourth quarter. Bye bye, September. Bye bye, third quarter. Bye bye, whatever happened in the past. Let's hope we have an Uptober. Let's have a Moontober. Uh, it's starting quite okay. So, that's a couple of discussion points we have today. We've written out 5 things for the day. I want to give you a couple of updates on Cake. We have quite some exciting things to share here. We're going to start off with that. We're going to go into, obviously, reflecting on September, Q3, the entire year so far. Bit of a idea what could happen. With that, we're going to go into topic number 3, obviously Credit Suisse. Let's see what's going on. We have our Swiss expert with us, Fabio. How does he feel as a fellow Swiss countryman there? We're going to have his opinion, obviously very, very strongly on that. He looked up some really nice details. We're going to go into a statement that Dalio also made, which is cash is not trash anymore. He changed his opinion on this. And then with that, we see Meta and some other tech companies for the very first time actually going into maybe forecasting shrinking. Does this mean mass layoffs incoming? And is that the reason why Dalio talks about cash not being trash? And then last but not least, let's see how much time we have. We want to talk a bit about gold. Fabio has some very strong opinions. I have some very strong counter opinions. I came prepared with some data and some details and some charts. And let's see. So, yeah, that's going to be the outline. First and foremost, head of community, Fabio, how's everything going? How are you doing?
Yeah, just checking on. Yes. Okay. Hey, everybody. It's October, and I'm really excited. I made a tweet a few days ago. Even the stars are aligned because it was Mercury retrograde. I'm not exactly sure what that means. Like everybody that's into astrology definitely understands that.
You need to clean up your Twitter followers, dude. Like, you're following all these weird chicks on there that are like all like in very questionable clothing, talking about what the stars are doing.
Yeah, but they are aligned. So and it's October. So we had September, which also correlated with the stars. It was Mercury retrograde, and now it changed. So it's not Mercury retrograde anymore. It's I don't know,
Antigrade, yeah,
and
forward, yeah.
something that follows, and it's October. So and other things, of course, we have the midterms coming up, and we have seasonality, which is a lot stronger for October, November, and December than it is for September. And so I'm excited. It's still the sentiment is quite bad. On Twitter, Julian mentioned this briefly to me this morning that he doesn't really spend a lot of time on Twitter. I tried to do the same, but I kept being dragged in because I don't know, I spent way too much time on Twitter, and currently it's not the nicest place to be. There is a lot of frustration and bear market vibes, I would say.
Definitely. Lots to discuss. I want to start with some of the updates, though, first that we have on our platform. Let's start with the first one. Fabio, the most requested feature is back. I give you the honor to talk about it. I think you got pushed from left and right, and now it's back.
Yeah, it is back. And we already gotten a lot of feedback about it. So what are we talking about? It's a rewards dashboard where you can see some kind of graphical illustrations to track your rewards, to track your investment. And we know that there is still some key capabilities missing. We listen very carefully. You want all-time graphs, which are currently not available. We know. And the daily display is not what it should be. It's something is not working. We didn't have that issue in testing and on staging. We are having that issue right now. So the daily graph is not 100% working, but the other tools are. And we already gotten a few feedbacks that it's better to have the last 7 days or the last 30 days than to have this month and this week. So that is already forwarded to the right places. And we're going to keep iterating that. We know that our community and our customers, they want to have graphical tools and at their finger points where they at their fingertips where they can track their investments. So we're definitely keep working on that. But I'm super happy that it's back. It has been a long time, and but it's not the last you've seen. Let's call it like that. But we have one more important thing that we want to push out first before we're gonna go back to the reward dashboard.
We'll talk about that in a second. Yeah, I think I mentioned this last week as well. I just want to highlight we got honored by LinkedIn to be one of the top startups in Singapore, actually startup number 8, and there's quite some follow-up on that. I completely didn't expect how big of an impact that is. Just that recognition here is going to have a lot of follow-up, so that's quite cool. Thanks, LinkedIn, for that. Yeah, so we're still hiring. We're one of the few companies in the whole world, it seems, who are still hiring. kekdefi.com/jobs. So if you want to take a look, so that's quite exciting. Then also, Bitcoinist put us as one of the top projects to follow for 2023. So check this out. We'll put those links down below so you can look it up for yourself. And then one sneak peek that's going to come out later this week, and that's going to be a very, very exciting one. We had discussed this a couple of times already. Is the entire Ethereum staking on Cake? That's going to be really, really exciting. Stay tuned on this. The entire team has been working on that. We are very, very confident. Otherwise, I wouldn't be announcing it here that we are going to launch that. A couple of key points here. We're going to have best returns that you can potentially make, also because we are compounding the returns. So that's going to be very powerful. So we should have top-notch returns. Our notes are going to be hosted in Singapore. We're not going to use any of the US or European types white labeling solutions that so many other platforms are using. So we're going to really build on the Switzerland of Asia here in Singapore, being very crypto friendly. On the other hand, being very cautious when it comes to the entire framework at the moment. So I think that's going to be very, very powerful. And we're also going to have a solution how these ETH are going to be liquid. So that's going to be really, really good. So you're going to have all the best kind of possibilities on that. That's going to be something that's going to be very exciting, especially with so much discussion right now and how centralized Ethereum is in the US. And that's going to be a very, very strong counterbalance there. Stay tuned on that later this week. I don't know, Fabio, if anything else you want to add on the Ethereum side or on other updates we need to make. But these would have been the 4 that I wanted to mention here on the from the company side.
We know that we are a little bit late to the party when it comes to Ethereum staking, but we also know that a lot of you guys, especially our core community and our long-term customers, you've been patiently waiting for us to bring that product. And I feel if you're comfortable in using our other staking services, it's going to feel exactly the same. So super straightforward, stake, unstake, as you are used to it. So super simple, super nice UI. And as Julie mentioned, the key point is definitely that this is, I don't know, one of the very, very few infrastructures that is running outside of the US. So both from a customer standpoint as from a ecosystem standpoint, this is definitely a huge benefit. And we know or we think there is a demand for that. We will see. We're in the late stages, so you will find a few announcements and things that we are sharing on the launch very, very soon on our social channels.
Great. With that, let's go into a bit of a reflection, a bit of a looking into the crystal ball 3000 here. September is behind us. What do I mean with this? I mean, I think it's pretty obvious. If we look at the month of September, we mentioned this a couple of times. September tends to be one of the worst months actually for crypto. Together with the month of March. Actually, in crypto, the month was not that bad. Most coins, they went down, but it was not super, super bad. One thing one has to kind of point out was how strong actually Bitcoin held up in September. In comparison to all the other months when most coins did really well against Bitcoin. Ethereum did really well in all the other months. In September, Bitcoin really managed to shine. And I think that really is noteworthy as a whole, especially if you also look at what the rest of the market did. I mean, this is the general market in September. I mean, it's pretty much red, red, red. The only thing, healthcare sector kind of managed to stay strong here. One thing that really also stands out to me are the big power plays here and how much down they are. Microsoft, Apple, Google, Amazon. I mean, they are all down double percentage digits. That's pretty significant. I mean, here we're talking about Apple being down 10%. I mean, we're talking about over $200 billion in market cap getting wiped out. That's just incredible if you compare this to crypto, for example, or to many other companies, right? I mean, most companies aren't even that large in comparison to what Apple is just kind of fluctuating here on a monthly basis. So, absolutely significant. And then when we kind of dig a bit deeper here, we look at year to date. Yeah, I think it's really, really clear. NASDAQ, S&P 500, Dow Jones, everything really kind of going down. One thing I want to point out, though, and that's quite interesting, is the S&P 500 and the Dow Jones, despite doing better than the NASDAQ, which makes sense because of the tech sector, actually the NASDAQ hasn't done a new yearly low. So that low is still lower than that low here. For the Dow Jones and the S&P, this is different. And the reason why I want to point this out is crypto, especially Bitcoin, has actually been linked way stronger to the NASDAQ than any of the other indices. And I just want to point this out because this may be interesting to understand why has crypto actually not made that many yearly lows in comparison to maybe some of the stocks. And it's just, it seems, because tech has really sold off aggressively here in June, those lows haven't been broken yet, and they're and that is I think a very interesting one. Yeah, reflecting on that so far, and then I want to kind of talk a bit about what may be coming up in October Q4. I think generally, right? I mean, this is also no surprise. Q3 tends to be one of the worst quarters in crypto, especially, but also in stocks. I mean, there's this statement, that saying that says, when it may go away, but remember, be back in September. So, I mean, September was nightmarish, but generally that Q3 tends to be one of the worst quarters we can potentially have in crypto and in stocks. And so we discussed, obviously, why this was pretty much every week. We discussed the insane correction that the Fed basically did over the weeks, where initially interest rate hikes of 0.75% weren't even on the table, and then suddenly they became the ones that were the most likely. So I think not much of a surprise there. Reflecting on Q3, Fabio, how do you remember Q3 September before we then go a bit and look into October?
Yeah. So especially the last week of September, so from 21 September onwards, was surprising to me, and something I'm following very closely is, of course, the correlation that Bitcoin has with risk-on assets. And as you briefly mentioned, the surprising thing was that we saw a big sell-off, especially the Nasdaq and big tech, a lot of currencies as well, the pound, the euros, which suffered immensely. So a currency move of 6-7% is huge. Currencies normally don't move that much in a short period of time. And on Messari, I saw some data that there is clear inflows from euro and British pounds into Bitcoin. And also, so we had a few weeks, actually, or a little bit more than a week, where Bitcoin was holding steadily and even was up like 0.5%, while most risk-on assets were down 6-7%. I'm not saying that this is a decoupling, but it's something to keep an eye on, because I consider Bitcoin at the current stage, it's a leading indicator for risk behavior and liquidity. And right now, but I could foresee a scenario where Bitcoin falls a little bit more into the camp of gold, which we probably can touch on a little bit later. And maybe also an indicator that there is some systemic risk out there, which we're also going to touch on a little bit with Credit Suisse and a few other banks, and where people practically use Bitcoin, as Julian mentioned previously, as a little bit of a CDS, credit default swap, where they are kind of making a bet, an anti-establishing bet, where they say there's a chance of 2008 crisis chance, and they want to hedge their position, but nobody really knows how Bitcoin would perform in an event like that. So there's definitely a few things that are interesting in that development. Q3 was, I don't know, I think nobody expected Q3 to be, it wasn't that bad actually. So we had we're down like 20 something percent from the top, like S&P 500 and Nasdaq and so on. But it's not that this is a clear recession or a crisis that we are in. It's kind of that the crisis is visible. It, like, you can see the cracks in the glass, but so far it's just that the bond markets have some hiccups and are really weird to make sense of. And usually this is an indication that things are not running that great. And of course, you can see maybe that the Fed rate hikes have an impact on inflation. I really hope, because this is probably the most important thing to watch right now. This will define all future actions from the Fed. So yeah, I guess we need to hope that inflation is coming down and the Fed is slowly slowing down with rate hikes, or even thinking about pivoting. But it was not a really great Q3. Yeah.
Yeah, I mean, let's look at the status quo here. I mean, the S&P is, yeah, as you mentioned, down. We looked at the chart before. We're down minus 20 on the Dow, up to minus 32 on the Nasdaq. And then looking at the S&P here, I mean, neither in length, so how long this entire downward cycle has been so far, are we anywhere extraordinary? Also on the crash down. I mean, if we talk about COVID, or we talk about the great financial crisis, we talk about .com. I mean, we have so much kind of further down here, actually twice that down. If we look at Bitcoin, Ethereum, I mean, on both, we actually have a little bit further down. We have actually way more in time still. So, I mean, it would be super surprising if that is the kind of end of the bottom. It could easily be that this is the bottom, but it would be surprising if we are seeing actually a turnaround here in comparison to all the past kind of cycles on all of that. So I think that's really interesting. Looking at Q4 and obviously looking at October, there is a reason why people are talking about Uptober. It's not all too surprising, to be honest. First of all, just looking at the monthly chart, October tends to be one of the most bullish months, together with the months of February. February, for those that don't really know why this is, mostly two reasons. First of all, January tends to be a rather bearish month, also because of a lot of the tech selling. And so February tends to correct a little bit here. So that has always been one of the reasons on that. So it's mostly also just because of the relation here, January being so bearish and February then being so bullish. And it's a similar kind of sentiment here as well. So the reason for Q4 as a whole to be strong, and that's not only crypto, that's also general markets, obviously a lot of it has to do with generally Q4, end of the year, people wanting returns. But then because it is so bearish in Q3, especially September, October tends to be a relatively strong month. In the stock market, that actually is a very, very, very impressive kind of statistic. And I mean, again, statistics are what they are, statistics. But then still, as a good investor, you actually look at statistics and you look at probabilities. So whenever September is so bearish as it is as of right now, and we have one of the worst Septembers here in a long time, generally there's a very good chance that then October just tends to be a strong month. I want to kind of point one thing out though, and to me that's really important in that entire kind of flow. It could easily also be, just like we have seen in July, that this is more of a run up in an actual downtrend. So just be careful that you distinguish between a falling knife and a bouncy ball. It's okay to trade the bouncy ball, but just be super, super careful that you understand what it actually does. And that's just something that is super, super key to understand in that. But there is a really good chance that we are seeing a relatively strong Q4 and also in October. And then on top of that, obviously, we have midterm elections coming up on November 8th. A lot of it is going to have to do with the signaling of the Fed. Obviously, we don't have a Fed meeting, or unless there's an extraordinary Fed meeting here now in October. We should have the Fed meeting beginning of November and then end of December. So that's going to be an interesting kind of spin there. Next week, we're going to see CPI numbers. Let me just pull it up. I actually have this stuff saved in my calendar. That's how prepared I am and all that. So that's actually coming out next week on the 13th. So next week, we should have that consumer price index, and that's going to be for September. That's going to be interesting then to obviously see a bit the trend there. I tend to belong to that group of people that actually thinks we're going to see a steep fall off of inflation rather until the end of the year. So maybe we're going to see this already for September, but I would be super surprised if we don't see that then for November at least. So in 1 or 2 months. So that's going to be an interesting one. That's a bit of my expectation going forward. So before we then go a bit into Credit Suisse, Fabio, Q4, your expectations. What do you see generally by influencers? What do you see out there in the markets? What do people talk about? What are the things that people share? What does the astrology look like? Yeah.
Yeah. So there is definitely this sense of the glass is cracking. You can see not everything is healthy. You can see this with a few banks like Deutsche Bank, Credit Suisse. You can see it in the bond market. You can see it in the behavior of the Fed. They had an emergency meeting yesterday, and these meetings usually don't just happen like that. There is a reason why they have meetings like that. And I'm not sure if the narrative of a soft landing is still possible. I feel like with the Fed is hiking rates very aggressively and with a lot of commitment. And at one point, there needs to be demand destruction. So we're entering a recession. And I don't think that recessions can be orchestrated as a soft landing. I think a recession is painful, and it's also painful because we make it painful, because we try to anticipate the future, and we try to change our own behavior, maybe not buying another car, maybe not going on this extra expensive vacation, maybe taking it down a notch with our spending. And the same of course goes for institutions. And all of these things, they lag behind. So housing lags behind, unemployment lags behind, and the impact of this. And also, if there's a change in monetary policy, this will impact fiscal policy. So there is like a process of things that begin to move when monetary policy starts to change. And a lot of people actually believe that there will be this super hard pivot where the Fed wakes up and says, okay, we're going to drop rates, we're going to stop raising rates, and everything will turn around like March 2020. And I don't believe this at all. Like if you compare it to, for example, 2008, we had the Fed was actually starting to hike rates while prices still were moving up. So they were anticipating. And even if when they pivoted during the crash, during the great financial crisis, which wasn't that great, actually, it was just a normal recession. During that crisis, at the end, they pivoted, but prices continued to drop because fiscal policy and things just took its course. And it actually took a while until the market bottomed and started to reverse. And I can foresee a similar scenario as well. It's so hard to predict the future and to say what the Fed is going to do. Yeah, but maybe this is a good point to start to look at the unhealthy stuff that is out there. Maybe one of the things that is currently vividly discussed on social media is Credit Suisse, alongside maybe with Deutsche Bank or another few banks that are kind of in they became the target of a broader fin Twitter, crypto Twitter, and so on.
Yeah, but maybe let's kind of start this from the base for everyone that maybe doesn't have the same kind of financial education that maybe some others. I think all of this started probably last week, and in case this stuff really starts unraveling, I think the end of September, that last week of September, would be that watershed moment. And at the end, it all kind of started with the UK. We talked about this. Maybe the quick summary on this is the UK, in my opinion, did a bit of some aggressive moves when it comes to obviously raising interest rates, which makes sense. At the same time, doing quantitative tightening, which I think makes sense. At the same time, though, becoming a bit aggressive on how the tax dollars would get spent or not get spent, and then just caused a lot of uncertainty in the markets, which at the end led to a lot of the pension funds really, really, really struggling in the liquidity, which then became this self fulfilling kind of crises that we had discussed several times already, especially when we talk about repo markets. Just for comparison, also the US had a bit of a dip here, but this is nothing out of the extraordinary. People, I even saw Arthur Hayes kind of pulling this up and talking about some extraordinary moves, but this is not an extraordinary move here. I mean, an extraordinary move in the repo market would really be a significant kind of down. And this is basically here over the last year. So it's not a extraordinary move. So something further down, that would be a bit crazy. But the UK really had this massive issue, and the entire thing, and just look at the scale here, right? Went from 120 all the way down to 40. So we're talking about, I mean, this is like crypto prices over a week, right? So it's just insane in how the kind of the pension funds kind of had to deal with these assets. And now, and this is exactly this example we've been discussing several times. Imagine all of us going on a trip, all of us putting $1,000 in as this is our collateral, so that when people are paying on that trip, we don't have to kind of everyone just pay all the time. It's just like one person pays and we know there's enough money in the pot so that everyone at the end can get paid. Well, the problem is if whatever we're putting into this pot suddenly drops by 2/3 in value, I'm like, dude, like, I'm not sure you're actually gonna be liquid or not, right? So I don't actually know that you can pay me at the end of the trip. And now this mistrust starts, because then now I'm like, hey, I need you actually to do the next payment. So let's say we have this next flight booking and I need you to book that flight. And in this very moment, you may not be liquid, right? So just in this very moment, it doesn't mean that maybe an hour later you're not liquid again, an hour earlier you weren't, just in this moment. And now this stuff starts unraveling. So this is where this all kind of started going crazy. And it took the Bank of England to really step in and say, listen, guys, don't worry. For the next, I think, 2 weeks, we're going to buy up any of our treasuries and we're just going to pump this thing up. And again, this just shows the craziness that's been happening. Within like an instant, these things rallied by 100%. It's just nuts to kind of see all this. And then everyone thought, oh, it's all good. But then this thing started spreading. And it's not clear if these things are actually connected. But many times I actually do think those things are connected. Not always exactly sure how, but I do think they are. And we saw it suddenly, Credit Suisse popping up. Obviously also Deutsche Bank, but Deutsche Bank has always been a bit in the news that their balance sheet is not super strong. And especially on Credit Suisse, the 1-year credit default swap. So these are insurances that you can buy on someone going insolvent. And those Credit Suisse credit default swaps pumped by basically 5x. And this basically just means the probability for Credit Suisse to go bust just went up by 5x. And that's significant, right? I mean, a 5x increase of probability is just absolutely significant. Deutsche Bank went up slightly as well. Barclays also went up, but nothing in comparison to what Credit Suisse did. And a lot of people then started kind of rumbling and mumbling, where's this coming from? Why is that? And obviously then the question was, is this a coincidence that right afterwards the US had this closed board meeting, was an expedited board meeting? Actually, not super extraordinary. One has to be very clear here. And it had to do with the fund rates, but the discounted fund rates. So there's a big difference here. These rates are the rates between banks. It's not a super extraordinary, weird kind of situation. But again, maybe now all these events are a bit weird, right? You have the UK first. Suddenly you have Credit Suisse and Deutsche. Credit default swaps, obviously, investors really kind of betting on the demise of Credit Suisse here. The Fed suddenly doing this expedited meeting yesterday. No details on that so far. And then people started, and that's always key, people with not so much detailed knowledge then start, like obviously on Twitter and crypto Reddit and so on, they start debating and talking stuff. Despite the US going really a bit of a crazy kind of path here, this is the year-over-year change in in the DXY, so in the dollar index. And whenever this thing becomes too strong, this generally means that there's something kind of really going haywire. And so we're definitely going in a direction where everything is going haywire. I think Jerome Powell even admitted that probably a soft landing is out of the books now. But all of that, right, it's just really, really strange. Now, be very clear, repo rates seem to be in control. Maybe they are in control because of the Fed meeting, could be. Obviously, Credit Suisse tried to appease investors. It seemed to work for now. This is pre-market. We're back to 419. This is basically where we were prior to this entire kind of sell-off. So at the moment, Credit Suisse is doing fine. Maybe just as a bit of a outline. I mean, that stock that's a 27-year view here. It's all-time low, basically. Absolutely insane. Just to kind of think about that. But all of that obviously begs a bit of the question, what the heck is going on? Are we seeing the system breaking right now? This shows why there's so much trading also with Bitcoin. There's maybe some interest there because of Bitcoin. In theory, that breaking apart of the financial system is that insurance that we always talk about in why you should always have a certain percentage of your net worth in Bitcoin. And it's, yeah, and again, my personal view, and then Fabio, I would love to have a bit of your input. My personal view is that this is not going to be the breaking point right now. But when we look back, let's say maybe in 2 years, it could be the start of the actual kind of issue that we're going to follow. And especially when we then look at a quote from Ray Dalio soon, I think that's where we are. But always remember, a lot of people, especially when they have made bets that are on the contrarian side, on the other side, they tend to believe that timelines are way shorter, right? People who bet on like these things falling apart, they believe this is going to happen tomorrow. They don't understand how long some things may take. And I believe that this may be a start, but definitely not that now everything is done. But Fabio, have a bit of your thoughts and ideas, and I don't know what you have to share there.
I'm 100% aligned. So the first thing which I would love to start with, if you ask yourself the question, and this of course goes to our listeners, what started the financial crisis of 2008? A lot of people would say, Lehman Brothers. It was all Lehman Brothers. But what a lot of people tend to forget is that a half year earlier, 6 months earlier, actually Baron Stearns kind of was, and I think the similarities between Credit Suisse and Bear Stearns are mind-boggling. Like there are so many similarities, but so a lot of times the food is not that hot as it's cooked. And right now, so let me briefly touch on a few key facts around Credit Suisse and why Credit Suisse is probably not Lehman Brothers, even though their CEO is named Alex Lehman. Not to go into, I can do some conspiracy theories later, but what is the issue with Credit Suisse? So their stock is down 74% since all-time high, and they haven't been doing very well. And I would say, so there is some concerns when you look at their balance sheet. So they have, and I'm just going to round a few numbers here, not going into specifics. So their equity and cash positions are approximately 200 billion, but they have 900 billion, almost $1 trillion in leveraged exposure, which of course is not healthy because as an institution, as a bank, as an investor, you probably should not be more than 100% leveraged. But to put this in perspective, this is completely within the law. So Basel II and Basel III, the agreements that the Credit Suisse follows, they're super legit. Everything is in order there within the risk-taking that they're allowed to be, even a little bit better. So they have a ratio of, I don't know, it's hard to get the distilled information out of these leveraged products, because you can look at a balance sheet, but you don't know exactly how this leverage actually ties together. So it's, I would say, between 4 and 6x. Their price to book value is pretty low, lower than almost all other banks, lower than Deutsche Bank, which is approximately at 33%, and Credit Suisse is at 24%. And they are a big company. They're one of the biggest banks, and they're like a systemic. They're too big to fail. You cannot drop Credit Suisse. This will have a large impact on everybody else. But what usually happens is if you read things like that on social media and like these rumors cook up and the credit default risk spikes up, this usually doesn't mean that the company goes bankrupt and everything is exploding. This is just people betting on these outcomes. But usually this means there is an operational issue, which Credit Suisse definitely has one. You need to just, if you look at their financial statements, they spent 2.3 billion in compensation and salaries, and they lost 1.5 billion just in the last quarter. And so, like, there are some operational things that are clearly unhealthy, and they know they have 51,000 employees, and they will probably let go 10% of their workforce just in October. They announced 27th of October that there will be more information on the restructuring and that they want to raise 4 billion for to keep up their operations. All of this sounds pretty reasonable. You know, these things happen, bad operations happen. It's a tough business. They lost like clients margins. They went like down from 8.9 billion into the millions. So they don't make enough money. But there is a likely chance that they will be able to raise money, or that there will be some kind of merger or whatever. You know, there's many outcomes, but it doesn't look to me, at least, as if Credit Suisse is going to be the main reason for I don't know, another financial crisis or so. It's definitely showing that there are some issues, that there are some banks that are unhealthy, but they like a few things are just crazy to me. Like the CEO of Bern Stern, at the time he tweeted, I think, almost the exact tweet as the CEO of Credit Suisse tweeted out, like, liquidity is great, the balance sheet is doing good, don't focus on the stock price. Something like that was the tweet of Bern Stern, and the Credit Suisse guy tweeted out the same thing. And of course, Bern Stern was bought by JP Morgan for, I don't know, $2 or $3 a share. And maybe something similar can happen to Credit Suisse as well. But usually, I don't know, right now the rumors are cooking up. The memes are going out. You know, there is like a meme account that calls itself Debit Swiss. But I'm not too concerned about this whole situation. I will follow it very closely, and there is a chance that this is going to blow up, but I would put this chance, I don't know, certainly lower than 50%. I'm not a financial analyst. I don't know, but for me, the rumors are definitely taking overhand. But it's super interesting to follow the whole process and what's happening to Credit Suisse.
I mean, the markets are betting on a 5% probability right now, right? So, I mean, this is markets. So, I talk about this a lot. It doesn't matter what people say on Twitter. It doesn't matter what journalists say. It doesn't matter what politicians say. At the end, what really matters is what people with skin in the game say. And in this case, markets participants are betting at a 5% probability. Again, I also agree. I think it's a very low probability, also because if this was pre-2008, then I think it would be way higher, because people would be way less aware of the risks. So, and then maybe to tie the idea here that Fabio mentioned, so they're leveraged by about, let's say, 5x. The question is, right, they're $200 billion. How much is this worth in the market? And now this is our $1,000 for the trip, right? And so if those 200 billion suddenly drop by 50%, and again, we don't know because we don't exactly know all of this, it could easily be that suddenly they're leveraged by way more than 5x. And then all the other people are saying, hey, listen, I don't believe that at the end of the trip you can actually pay up. So we need you to post collateral right now. And then that's exactly as me asking you to pay for your flight right now, and maybe in this very moment you can't. So that is maybe where a lot of these issues came from. But it seems right now the market is actually agreeing with that this doesn't look as crazy as initially. So at least for right now, I mean, maybe tomorrow the situation has completely changed on this. With that, let's take it a step further. We have one of the most successful and most famous investors come out to change his opinion completely. And he came out with a tweet. He was highly criticized under the tweet. Ray Dalio posts, as John Maynard Keynes' credit was saying, when the facts change, I change my mind. What do you do, sir? And along these lines, the facts have changed, and I've changed my mind about cash as an asset. I no longer think cash is trash. At existing interest rates and with the Fed shrinking the balance sheet, it is now about neutral, neither a very good or very bad deal. In other words, the short-term interest rate is now about right. Very, very, very interesting statement. A lot of people, I mean, you can see this. I mean, a lot of people commented and criticized him for it. Others congratulated him about being like open about this. Obviously, one of the criticisms was, well, it's great that you're telling us now, like 10 months afterwards, when everything has been crashing. You should have told us 10 months ago. You're the one who made 25% returns year to date, and now you're telling us the secret and so on. I want to put this to one kind of angle, though. What if Ray here thinks that we actually still have the worst ahead of us? And I mean, that's something I've been kind of talking about a lot. I don't think we're going to see that worst this year. I still think we're going to see it next year. And a lot of it could come from large tech companies shrinking. We have Apple downsizing their production on the iPhone. We have Meta for the very first time ever to downsize their operations. So they're expecting to be a smaller company by the end of 2023. And I mean, if we look at so many of the resignations out of the executive team in so many large companies, right? And a lot of these companies, or the CEOs, execs, CFOs, obviously they know what's going on in these companies, right? And so a lot of them are saying, you know what, I'm more of a good weather CEO. Like I'm gonna not deal with all this crap right now. I'll let others deal with this, and I'm gonna resign right now and just step away. So what if a lot of these things are still ahead of us? And I would be very cautious in believing that cash is a great investment, despite Tether and Circle are probably gonna they are shitting money right now. I mean, really. I mean, if you just look at them having 60, 70 billion in cash at 3 to 4%. I mean, they're shitting like 2 billion a year and with zero operation cost. I mean, their operational cost is so tiny, it's absolutely insane. I mean, yeah, it's what these two companies have right now is just absolutely crazy. But I would still be careful in saying that cash is a really good investment. On the other hand, right? I don't know how many people when I post on Twitter, would you be okay in going on a, let's say, 1 year or 2 year bond and getting back 4% the next year, but you have a guarantee on capital? Or would you be okay in getting back 8% in the next 2 years and have a guarantee on your capital? So many people, I think 80% of people on that poll said no, they would never do that. They have way better investment ideas. And that just absolutely just shows, right, how what the thinking is. The 1 year forward looking expectancy on inflation is less than current bond rates. So people are betting on lower inflation rates actually in the market. So I'm not talking about me stating on a video that we may see deflation or something. Actually, people betting their money on swap rates are lower than 4%. So it's very, very interesting to kind of see this, what that mismatch is kind of like. And very difficult what to make of it. To me, it just kind of underlines how important it is to be super diversified right now. You want to be in crypto, you want to be in stocks, you want to be in cash, you want to be in bonds, you want to be in precious metals, you want to be in commodities. It just highlights that. And it shows how crazy those changes of opinions are. And again, how much people struggle with that. It was so interesting to see that reaction from people. And I just felt that was very interesting. What are your thoughts on that, Fabio?
On the diversification part, I couldn't agree more, especially when it comes to precious metals. I also I think a cash position. If you were in cash for the whole year, you actually performed quite well, even though we had high inflation, but just because everything else is down more. But here it's probably mainly the US dollar that you want to be in, and probably not the euro or the pound. And this is exactly the argument I would like to make, because a lot of people, they confuse a strong dollar with weak gold, because gold is not weak at all. Gold makes new all-time highs in euros. It makes new all-time highs in Turkish lira. It makes new all-time highs in British pounds. If you're the only current, the problem is people use the US dollar when it comes to gold, and gold is not performing very well if you compare it to the US dollar. But everything is not performing great against the US dollar because it's just a dollar strength. The dollar is sucking up all the liquidity because the whole world's debt is denominated in US dollar. But if you are from any other country of the world, like for 90 or maybe 95% of the countries, this is true. If you store a part of your net worth in gold, you actually did pretty well. Like for me, for example, I'm in a European country. My expenses are in euro. I'm up 9% this year on my gold position compared to the currency that I spend. And we have a 10% inflation rate, which means gold did exactly what it should have been doing, meaning protecting my purchasing power. And not only that, a lot of people, they forget one thing. So gold is mainly traded by Western countries, and we have kind of a monopoly when it comes to the price discovery of that. But there is a clear trend that the BRICS countries, so this means Brazil, Russia, China, South Africa, and a few others, they are setting up their own gold exchange. And gold, it cannot be suppressed forever. There is a lot of banks, a lot of institutions that suppress the gold price. And this is, this used to be a conspiracy theory. It's not any longer. Like, this is, I would say, public knowledge that there is some suppression happening on the gold price. But you need to ask yourself, as an investor, you need to ask yourself one question. Gold was perfectly able to store your purchasing power for more than 2,000 years. If you are really thinking that this time is going to be different, sorry, but it's not. Gold is not going to weigh. Bitcoin is not going to take over gold. Bitcoin is something else, but the 10 trillion that gold has stored, this is going to continue. You have so many things that play into this. Industrial use, cultural use. Like if you go to India, for example, people like to have physical gold. And of course, yeah, here in the West, it's true that some millennials feel gold is not a good position, but like facts don't care about feeling. And I'm 100% sure that gold will do a perfect job in storing purchasing power. You're not going to get rich by investing in gold, but that's not what gold is about. And just to maybe one thing that is astounding. If you go, we had the Munich Oktoberfest in Germany. And this event is hosted since the 50s or the 60s, so 70 years. And if you measure how much beer you get for fiat, for US dollars, for euros, or you can see that every year this is increasing and you spend more and more and more for the same amount of beer. If you compare this in gold, it's extremely stable. Like you get the same amount of beer for the same amount of gold every year since. And this is what gold is all about. Gold is not to make you rich and to outperform the market. It's just to keep your purchasing power. And for example, we talked about Ray Dalio. Ray Dalio makes a clear recommendation to keep about 7.5 to 10% of your net worth in gold. And in times like this, it's maybe even recommended to have a little bit more, because what happens usually, and this is just historical data, what happens if a recession or a financial crisis ends? So there is a sort of a switch that slowly gets turned when it comes to risk behavior. Initially, all the liquidity dries up and everything sells off. This was the case with gold in the 80s, in the 90s, in the 2008 financial crisis. It sold off drastically. But it's usually always the first one that picks up speed, the first one that starts performing when a little bit of confidence comes back into the market. And for me, I'm very biased on this. I'm a huge gold bug. I have been since more than 10 years. Gold is what led me to Bitcoin, but I never sold off a large part of my gold position. Still, I hold a substantial amount, which probably amounts to 30% or so of my total net worth. I hold that in gold, both physical and GLD. And I'm not planning on selling anytime soon, because I really feel that even measured in US dollar, that gold could hit easy 5,000, 4,000, 5,000 within the next 10 years. Easy.
Not financial advice.
Not financial advice. Sorry, yeah. It's just dubious speculation. Dubious speculation. Yeah.
And by the way, we have the GLD on Cake DeFi. So if you want, you can get exposure to decentralized gold. I want to maybe add a few of my thoughts, and then I'm going to show you a chart. Just as my Bitcoin position is not at the moment an investment position, but more of an insurance position. That's why I have a very low exposure to Bitcoin right now and exposure to other cryptocurrencies like Ethereum or DeFi chain way more. I've never been much of an investor in gold, other than, again, for the very same purpose actually as Bitcoin, as an insurance. I'm a typical Warren Buffett disciple on this, where I always believe that great businesses will always outperform a piece of metal. And I want to show you maybe a couple of nice graphs that actually show you how this is historically correct. But then I actually want to show you how Fabio is actually really correct on a couple of those statements. So this is the current gold price measured in US dollars, and it is relatively high, but obviously way down already from its COVID peak here. Gold in dollars, so this is against the dollar printed, so this is against M2, is doing not terribly well. But it's not like a constant downstream. That's also important, right? So if you look at the purchase power against the money supply, obviously that will be one line down, just because obviously it would go down, 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 down. So here it's not so bad. Let me show you why I generally am a stock investor, and then I actually show you why maybe at the current moment gold could be way more interesting than stocks. And that goes totally against talking my own book, because I'm absolutely not overexposed in precious metals and gold. So this is gold against the S&P 500, and you can see, I mean, generally we have not done well. So whenever this graph is low, that means stocks have done way better, because gold is here basically in the denominator, so it goes down the higher this number goes, and gold has to do really well in order for this thing to go up. And the actually exact same kind of trend has been here. .com, it did a little bit better. It really took off here though into the financial crisis, and especially out of the financial crisis. Exactly what Fabio has been saying, right? So that's exactly what he basically is saying. So if you would go and believe that we could see something again here, then gold could really take off in comparison to stocks, right? So that's really the key thing. If we look at how it did against the dollar, we actually see the exact same number here. Gold really kind of went off, and the last time gold really then hit that all-time high again was then with the COVID bubble, right? So why am I bringing this up? Well, there may be a good chance, depending on what's happening, that maybe right now there's a good time to buy gold instead of buying stocks at this very moment. And most of the times, though, I want to be very clear, right? This is actually not the case. Most of the times, gold underperforms stocks, but then there's these really crazy kind of peaks here. I mean, look at this, right? So basically, there was a time of 6 years where gold really outperforms a very random, like 500 large companies, right? So I think that's just very important to understand. Yeah, I just want to put this in. Again, you can go to cakedefi.com. We have D Gold on our platform if you want to get exposure there as well. I don't know, Fabio, if you want to add anything there.
No, it's usually I'm considered, like within Cake, the company, and also within my circle of friends or the private groups I'm taking part of and talking about investment. I'm considered super conservative, and because I have a big position in gold and mainly in Bitcoin. These are the two positions that are substantial in my personal portfolio. But a lot of people think this is super conservative. Because both of these assets, as you said, usually there are other blue chip stocks or altcoins that perform a lot better in bull markets, and this is 100% true for everybody that can pick these players. Only the sky is the limit. But for me, like one of the behaviors that changed for me the last 10 years or so, or that I kind of learned for myself, is I don't want to lose money. Like I'm okay with just performing on a market average rate. I'm okay with just having the performance that blue chip cryptos or blue chip stocks give me. And in times like these, like in a bear market, I'm completely okay with just keeping what I have. because you can also lose 80 or 90% of your money, which is devastating, especially if you spend a lot of time saving for it. And yeah, so I'm really excited about what is about. We have the midterms coming up. We have a Fed meeting in November. We have the results that inflation will new inflation data, which I really hope is going down. And yeah, it's going to be super exciting. That's it from my side. If you're listening to this for the first time, we're always doing this on a Tuesday. Next week is going to be an exception. We're going to do that on Monday. But you can always find recordings of this on Apple, Spotify, and YouTube. And yeah.
Appreciate it. Yeah, thanks for all the insights, Fabio. I think it was a super interesting session. Yeah, if you're not a customer, go to cakedefi.com and sign up there. And otherwise, click subscribe and leave us a like, a nice comment, review, whatever to help us. I hope you're getting value out of this. See you next week. Hear you next week. All the best in the meantime. Thank you so much. Yours truly, Julian and Fabio. Bye bye.